Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Lead Partner. Welcome to our March 2016 IFRS Insurance Webcast. Today's webcast is titled The ISB Takes Decisions on IFRS 9 Decoupling. Strategic deliberations on the interaction between assets and liabilities accounting before IFRS 4 Phase 2 is mandatory. As always, we have structured our webcast with the simple 3 items agenda that starts with the highlights of the ISB meeting on the 15th of March 2016. Then we'll spend most of our time to analyze the staff papers and their content, the ISB discussion that followed their presentation, and the tentative decisions they've reached. Especially for this webcast, we will also make a comparison with those decisions and the Deloitte comment letter on the same subject. And then we'll complete the webcast by talking about the next steps that will follow from this meeting last week. The highlights for today are the 5 strategic decisions that the ISB has reached on the IFRS 9 decoupling exposure draft. 5 of them. The first one is that they will provide a temporary exemption, so there will be a deferral approach in the future text of IFRS 4, and that will be, as expected, subject to certain qualifying conditions. The second decision is that this deferral approach, the eligibility for temporary exemption, should be determined at the reporting entity level only. And that is perhaps, from a Deloitte perspective, a disappointing outcome, because we were recommending to be able to apply this deferral approach also below the reporting entity. But we'll talk more about that in a moment. The third decision is that there should be a fixed expiry date for this deferral approach. Then they also confirmed that they intend to introduce also an additional solution to the decoupling problem, which will be the overlay approach. And finally, they decided and confirmed their intention to make both the deferral approach and the overlay approach as accounting policy options if the entity qualifies for their use. As you can see, in this meeting, they have already reached a very significant amount of decisions that will set the path for completion of this project in a very narrow way. But let's have a look at how this whole set of decisions has been reached by starting with an introduction to the meeting. As you know, the comment letter period ended on the 8th of February, and we know from the staff paper that 96 letters were received. And the comment letters were all focused on helping the ISB finalize an amendment to IFRS 4, not IFRS 9. And this amendment will be aiming at resolving the accounting mismatches that will arise on adoption of IFRS 9, with fair value gains and losses that were not reported in profit and loss being reported in profit and loss for the first time on adoption of this new standard for financial instruments. It's important to remember that at the same time, in the last 4 weeks, the board has also given permission to the staff to commence the ballot and drafting of the forthcoming insurance contract standard, and this is a process that is currently moving on. And the effective date of that standard, which has got a bearing on the expiry date of the deferral approach, of course, will be decided later on this year, when the drafting of the new standard on insurance contracts is sufficiently progressed. So that is the context to bear in mind. The debate started by looking at the paper that summarized the feedback received from all constituents except for users. So this is Deloitte and the other auditors, preparers of financial statements, etc., etc. And the theme that emerged from this paper is that most commentators supported the amendment to IFRS 4 to address the decoupling problem, and also that preparers voted by their consensus in the letter to support the deferral approach as the superior approach, the one that, in their opinion, will be the only capable of addressing all of their concerns. And their view was shared by most auditors, including Deloitte, accounting and actuarial bodies, and national standard setters. A few preparers, the paper of the ISB staff has noted, were actually not convinced that there was a need to do something about the decoupling, and a few others that felt the need was there said that the only solution necessary was really the overlay approach. These preparers were mainly bancassurers. The paper also has highlighted that most respondents believe that the population of entities that would qualify for the deferral approach is too narrow, because there are entities that would not pass the quantitative criterion proposed in the exposure draft, despite regarding themselves as insurers. And this failed qualification for the deferral was commented negatively in these letters, and a recommendation to reconsider this outcome was put forward. There were mixed views as to whether this eligibility assessment for the deferral approach should be done at the reporting entity level only, as proposed in the exposure draft, or it should be permitted to be at below reporting entity level. Most regulators supported the assessment only at the top of a consolidated group, whereas the preparers, national standard setters, auditors, including Deloitte, and accounting and actuarial bodies supported an approach that applies the deferral approach also below the ultimate parent company in the preparation of that ultimate parent company consolidated financial statements. We call that in our letter a waterfall application of the deferral approach. Respondents had mixed views also on whether there should be a fixed expiry date for the deferral approach. Regulators, standard setters and auditors, including Deloitte, supported the fixed expiry date, whereas many preparers preferred, I would call it a floating expiry date. So they agreed with the principle of having an expiry date, but they felt it was more effective for that date not to be set in stone with a particular day in the calendar, and instead to be linked with the mandatory effective date of the new IFRS on insurance contracts. The discussion that followed had a few interesting points. The first one I wanted to report back to you is that the board members appear to be not convinced that the incremental costs arising from the early adoption of IFRS 9 compared to IFRS 4 Phase 2 would be as extensive as suggested in the comment letters. And particularly, they were not focusing on the actual cost in its own right, but mainly on the difference between the cost and the benefits. And their focus and their sort of observation was mainly on the benefit side, and they observed during the debate that IFRS 9 will provide useful information, and because of that, surely any cost incurred to prepare it, to explain it to investors, would not be wasted. There was another comment on the deferral approach, and this is that given the many different classification of financial assets that would be possible if both IFRS 9 and IAS 39 are used in a set of financial statements, the waterfall application of the deferral approach was deemed to be a real problem for the SB to accept. Investors, they noted, tend to compare bancassurers with other banks, and so the point that was made in certain letters that there should be comparability with insurers and bancassurers was criticized, or if you like, subject to some questioning. So applying IFRS 9 at the reporting entity level is important to preserve comparability, at least from a sectoral perspective. It's important to have a fixed expiry date, all the board members noted during the debate for the deferral approach, and further deferral, they said they will consider it. So they are not saying that once they chose a date they will never change it, but they will change it if and only if there are significant delays in the publication of the insurance contract standard. And right now, from our Deloitte point of view, we don't see any symptoms yet that such delays will materialize. And finally, the staff noted the recommendation on a couple of things that would be perhaps classified as minor points, but I think are important to be discussed in our webcast. The first one is about first-time adopters. You remember that the exposure draft prohibits a first-time adopter to use these solutions, the overlay approach and the deferral approach. And so the board noted that there's been a series of comments about that, and they will take that into account. The second one is when an entity with investments in an associate or a joint venture that takes a different approach to the decoupling problem compared to that entity, what should they do? Can they maintain non-uniform accounting policies as they apply the equity accounting method, or do they need to align the accounting policy? So this will also be discussed, given that there were comments from a number of letters. The next paper that the staff presented is the feedback from users of financial statements. So please note that there are two separate papers that include the body of comments and views that the SB has received. And one that I'm going to present you now is the one that focuses only on investors, the users of financial statements. And the users have actually provided their views in different ways, not only by writing some letters, but primarily actually through dedicated outreach meetings that the ISB has organized around the world to gather their views. And this paper is effectively the first time that we can see a consolidated account of what investors have been thinking on this issue of the decoupling of the two effective dates. And the first point that I wanted to raise is a concern that users put to the ISB staff and board members, and that is that the decoupling really makes financial statements less understandable and create disruption. That allegation was challenged. There were mixed views. A number of users actually thought that these additional accounting volatility that arises in between 2018 and when phase 2 is effective is not as disruptive as others may have portrayed, and noted that from their own personal perspective as investors, they don't rely entirely on the profit and loss to decide the quality of an investment, the quality of a stock. They also look at the metrics, and so they don't anticipate that the additional volatility that will arise with the adoption of IFRS 9 in the insurance sector before IFRS 4 phase 2 is adopted would change their investors' valuations in a particularly significant way. Other users had a different perspective, particularly from Europe and Asia. They said P&L is important, and so if there was increased volatility caused by the adoption of IFRS 9 ahead of the mandatory effective date of phase 2, it will have a negative impact because it will show the insurance industry more uncertain in terms of its earnings and therefore less attractive for investment. In general, the paper says that users who expressed concerns about potential increased volatility were also users that tended to have concerns about the two consecutive changes in accounting in a short period of time, IFRS 9 first and then IFRS 4 phase 2 later on, which is also one of the reasons a number of commentators in the non-users camp have raised as a justification to do something about it. In terms of the approaches proposed by users, many of them noted that IFRS 9 is an improvement over IAS 39, and because of that, it should be applied by everyone without suspending the application of the new standard for a segment, even if it is an important segment, such as insurance, because of an alleged interaction with another forthcoming standard. Most users thought that providing two approaches, especially if optional, would be too much, and the result is a decreased comparability of financial statements with the risk of confusing rather than helping investors. Most users, if they had their way, they would actually prefer to use just the overlay approach because it contains all the elements to ensure high comparability and high transparency. As you remember, the overlay approach requires the full implementation of IFRS 9 in line with the mandatory effective date, and then adjusts the profit and loss by reclassifying out of profit and loss any gains and losses that are designated as related to insurance contracts under IFRS 4, and reclassifying those gains and losses into OCI. Many users did not support the deferral of IFRS 9 as they felt it would introduce more limited comparability within the market, and it would also create accounting arbitrage, and also will reduce information content. Finally, the users who suggested the referral approach, there were some, were mainly insurance analysts from Europe, Canada, and Asia. And I thought that this geographical identification that the staff reported in their paper was interesting to share with you. If the board was of the view to proceed anyway with the deferral approach, despite what users, the majority of users at least, have been saying, then those users that would not like to see the deferral approach said, if you do go ahead, then please bear in mind a few things. And there are three major points that came out, according to the staff, from the various discussions with users. The first one is that there should be a deferral at the reporting entity level only. And so they would, as investors, be against what Deloitte and many others have supported, which is the waterfall application of the deferral approach. Second is that they want to have comparability within the insurance sector. So although this all or nothing approach at the top of the consolidation perimeter is what they prefer, they strongly recommend to revise the eligibility criteria in order for the criteria to capture all those entities that would normally be considered by an investor as insurance entities, and not produce outcomes of the application of these criteria that would be counterintuitive. The final point that he made in terms of material recommendations for the deferral approach, if it is adopted, is that there should be a fixed rate, a fixed date for that deferral beyond which it cannot be done. And this is 2020, so effectively confirming that they like the choice of the SB in the special draft. So on the 1st of January 2021, if the adoption of phase 2 is not already effective and already eliminated the deferral, there should be no possibility for any insurance company to defer any longer. And so the maximum deferral that investors appear to tolerate is 3 years and no more than that. The point on a short period of time for deferral was also made at the time when investors strongly recommended that the board completes the insurance contracts project as soon as possible. It's an encouragement that Deloitte has also made very clear in our letter. The investors reinforced a point that I think is very, very pertinent for all of us to remember, and that is the current lack of transparency and comparability of insurance contract liabilities is a competitive disadvantage for the industry. And if you hear it from the investors, that must be true, given that they are the ones setting the price for the capital that insurance industry has to pay in order to raise it. The discussion that followed was quite lively, and the first part I want to cover is the one around the expected loss model. The board agreed that clearly the users are interested in reading the quantitative information that comes from the application of this model because it's useful, and that is something that will certainly exceed any implementation cost that the industry may incur. Most insurers, was noted during the debate, must have by now some sophisticated functions that should possess all the necessary information to calculate an expected loss model impairment. And so that is an important practical point that the SB wants to take into account. Finally, there were differing views about the extent to which it would be necessary to maintain two systems to produce both IAS 39 and IFRS 9 information, and so that will also be taken into account in assessing the cost and benefits equation as the SB moves forward in their redeliberation process. The other part of the discussion was around project direction and the plan. And the first point I wanted to report back here is that several board members continue to display a lack of support for the deferral approach. As you remember, when the deferral approach was approved, it was by the narrowest of margins. the 14 board members were split equally, 7 in favor and 7 against, and it was only because of the chairman casting his vote in favor of the deferral approach that we have been able to see that in the exposure draft. So at least 7 board members may still hold significant reservations about the merit of this approach. But they also acknowledge that given that there is such an overwhelming support for it from the common letters, that must be taken into account, and with the necessary limitations of its application, it should be then included in the final standard. There was also a discussion around the potential for accounting mismatches to arise, and in terms of deciding what to do with this exposure draft, the board agreed that that was the one key factor to always observe, rather than giving an equal weight to accounting mismatches and cost considerations. So the cost appears to be, throughout the entire debate, to be downplayed by the ISB. And in fact, the cost of the overlay approach were debated specifically, given that there was a point that a number of letters, including us in Deloitte, raised. And the board seems to conclude that, in their wisdom, the costs do not appear to be as prohibitive, in particular because they will be associated with a discretionary choice. And so it's almost like implying that if you don't want to spend so much money to implement the overlay approach, you can choose to designate less assets. At least that's the way I read it. The deferral approach would solve the accounting mismatch and the cost issues. That at least was acknowledged. But because of that significant number of board members that are against it, and having heard also what users said, the board intends to make it available only under a very limited number of circumstances. This will be facilitated also by the fact that the board doesn't appear to have any sympathy for the waterfall application of the deferral approach, and so the simplicity of the deferral approach will probably be preserved at the expense, in my opinion, of its more widespread application to relevant financial assets. The final point I wanted to observe is the expected credit losses information would not be obtained with the deferral approach, and so the board intends to reconsider the disclosures under the deferral approach to see whether these could be adjusted to take into account, in particular, the feedback from investors. The debate then continued to consider the accounting policies, and this point on accounting policies is the critical one, because if you look at the preparers, auditors, etc. letters in favor of the deferral approach, you can see that everyone has been arguing for accepting that for a finite period of time, the inconsistency of accounting policies for financial assets should be tolerated, given the greater benefits you would achieve. But that was not persuasive. The board appears to reject it, and indicated that having consistent accounting policies is of paramount importance for the integrity of IFRS application around the world, and so they are not persuaded that this should be done with. The two extenuating circumstances that they have actually accepted in order for the deferral approach to be in place, and so to allow at least a portion of the market to be on a different standard than the rest, is simplicity. And the second one is that within that reporting entity there will be just one or the other. So they accept eventually to have diversity in the market, but the one thing that they don't accept is diversity in the same reporting entity. And that's why if the waterfall application is introduced, you destroy, in their opinion, both simplicity, because you have the complexity, for example, of explaining how to separate within the same reporting entity assets that go to IAS 39 and assets that go to IFRS 9. Also, you will have a complexity from an investor perspective. They will have to work harder to understand the performance of the assets of a reporting entity if they got all these mixed measurement. And finally, there is complexity because they will have to develop rules on how to account for transfers within that entity when the assets move from a portion of the entity that uses IAS 39 to another one that uses IFRS 9. So all these things clearly lead to the vote that we already know about, and in fact the debate was kind of closed by saying that preparers should be encouraged to adopt IFRS 9 as soon as possible, even before the expiry date that is going to be set in the amended text of IFRS 4. So when we came to the vote, here you see it spelled out in a numerical way, the 5 decisions that I talked to you about in the highlight slide. Provided temporary exemption was approved 11 against 3. The temporary exemption, the deferral approach should be determined at the reporting entity level only. 13 board members in favor, only 1 against. The deferral approach should have a fixed expiry date, 13 again in favor and only 1 against. There should be also an overlay approach, again 13 in favor, 1 against, and then unanimously a vote to make both the overlay approach and the deferral approach accounting policy choices subject to qualifying criteria being met. So this tells us that the board is really set in a very clear course to get this standard complete and published along these lines. I fear that with such an overwhelming majority it's difficult for us to anticipate a departure from these fundamental principles. Let me now spend just a couple of minutes to tell you how these fundamental principles compare to what we at Deloitte said in our response letter. There are 4 major areas that I want to comment here. And out of these 4, 3 of them we were in alignment with the IASB, but the one that was perhaps the most important for us is the second one, the eligibility reporting entity level only, that has been rejected. So we were supporting strongly the application of the deferral approach on a waterfall basis, but that has been rejected for the reasons discussed earlier. The other 3 areas, the temporary exemption being a good solution and to be kept together with the overlay approach if needed, that has been approved, as you know. We said in our letter that if the waterfall application of the deferral approach had been introduced, probably you would not need the overlay approach, but now we know that unfortunately they're not going to give us that, so probably it's better for the overlay approach to stay there just in case. On the fixed expiry date, as I mentioned earlier, we are in the camp of those that believe that a fixed expiry date is necessary, and we actually strongly encourage the IASB to move forward as soon as possible with the completion of the balloting of the new IFRS on insurance contracts, so we can have a certainty of application of the 2 major standards for the insurance industry. And then finally, we agree that both the deferral approach and the overlay approach should be accounting policy choices subject to eligibility criteria being met. So if we now look at the plan that the IASB is going to work through in the coming months, there are 2 major chapters, of course, the 2 approaches, and the work they plan to do for the first one, the deferral approach, is first of all, and most importantly in my opinion, they need to look at the amendments to the qualifying criterion and reassess whether the ratio that was proposed in this project draft is actually calculated in the proper way to achieve the goal of identifying all those entities with the predominantly insurance activity. The disclosure required, as I mentioned earlier, there is an interest to really consider again if expected credit losses really cannot be disclosed when you defer IFRS 9. The timing of the assessment, the proposal is to do it on the 1st of January 2018. We'll see whether that will be confirmed or whether they may adopt, for example, an average of balance sheets to calculate in order to avoid any particular spike of non-insurance liabilities that would affect the outcome of the criterion on the 1st of January. There is also the plan to decide whether an entity should reassess the qualifying condition in a particular way. At the moment, that is proposed in the ED, and the board wants to consider it again and make sure that any reassessment is robustly considered and laid out in the final text of the standard. And finally, we will also consider whether there should be an opportunity for an entity to stop applying the deferral approach before the fixed expiry date. At the moment, that is the case in this project draft, and we'll see whether that option will be kept or whether once you have elected to defer, you have to stick with it until either phase 2 applies or the expiry date arrives. On the overlay approach, the first and perhaps the most important piece of work that the ESB will be doing is to clarify the designation basis for the overlay approach. It's something actually that we recommended in our letter in Deloitte. Also, how to present the overlay adjustments in the statement of other comprehensive income. And then also there will be a reassessment of the disclosure to make sure that what is being asked to be disclosed is relevant. And two points that are to some extent connected. One is the possibility to stop the use of the overlay approach on a by asset basis. And the other one, similar to the deferral approach, is to stop the use of the overlay approach altogether before the application of the new insurance contract standard. As you know, at the moment, the overlay approach doesn't have an expiry date. And in fact, if we look at the other issues that I want to discuss, the discussion about having a fixed expiry date for the overlay approach is one of the things that the board intends to debate in the coming months, as well as choosing for good that expiry date for the deferral approach. And then they're going to look at the first-time adopters point that was raised by a number of comment letters. At the moment, the draft suggested that no first-time adopters can use either the overlay approach or the temporary exemption, and we'll see whether some concessions will be given. And also whether there should be an exemption to use different accounting policies when an entity that has got an investment in an associate or a joint venture and uses the equity method would find itself with an accounting policy for financial assets being made at each level and the same choice being different within the associate. And so should the equity accounting be adjusted accordingly or not? That's the issue that the ESB intends to debate in the next few months. Once all these points have been deliberated, there will be a due process report to confirm that all the steps have been taken, a request to begin the balloting process for what would be an amendment to IFRS 4, and then the question to board members as to why or why not they intend to dissent on the publication of the standard. This entire program is scheduled to be completed over the next 2 months. So between April and May, the two board meetings in these 2 months, this whole project will be done and dusted. So we are expecting two very intense, very rich debates in these two board meetings, and Deloitte Webcast will continue to follow them for you. And shortly after the meeting is complete, we will report them back in the usual way. If the decisions on all these matters are reached by the end of the May board meeting, then the staff believes that they will be in a position to publish the standard by September 2016. So we are looking at a very short work period of about 6 months from now. This work will take place in parallel with the balloting of the new IFRS for insurance contracts, which started last month. And it is plausible that the ISB will consider the choice of the mandatory effective date of the new IFRS for insurance contracts at the same time as they are finalizing the choice on the expiry date for the deferral approach, given that the two dates are so interconnected with each other. And if any of those balloting process issues are brought into the board for discussion, again, the webcast will update you as to what they are and the outcome of the debate. That is the last point that I wanted to make, and as always, I would like to close the recorded part of our webcast by inviting you all to put forward your questions now. Thank you.